Well, first you have to define what inflation really is. I mean, I'm just shocked when I hear people talk about inflation. Kamala Harris, Vice President Harris, lead candidate for the office, thinks that inflation comes from price gouging. That's the real problem that we have, is corporations are gouging prices. Well, I mean, I went back and I looked at the profit margins of most corporations and they haven't budged. When you think of price gouging, you're thinking, well, your costs are flat and then you're just raising prices like mad on the consumer, and that's not what happened. But what happened is that the Federal Reserve from 1913 to 2008 printed $800 billion from the horrible creation of the Federal Reserve all the way through. It's 95 years. It took them 95 years to print $800 billion of what is known as high-powered money, base money supply, or the Fed's balance sheet. Pretty much all the same thing. And then in 2 years, Chair Powell printed $5 trillion. So when it took 95 years to print 800 billion, it took Powell 2 years. And actually, since 2008, the Fed's balance sheet went from, as I said, $800 billion to $9 trillion. So $9 trillion, $8.2 trillion of money printing since the global financial crisis. That is where your inflation came from. Now, inflation has eviscerated and wiped out the middle class of this nation already. Or I think they wiped out the bottom 4 quintiles. So inflation, as the politicians would like you to believe, is, okay, the rate of change has come down. True. So is that what they really mean? When people, the average Joe says, inflation has come down, he means the level of prices is falling. That's what he wants. That's what they need. They need home prices to fall 40% to be affordable. 40%, not 40, to put them back in historical means. Food prices are up 50% in the past few years. They have to fall. But what's happening is that we're not getting deflation, we're getting disinflation, and on a rate of change basis, better. So 9% increases are worse than 3% increase in prices, but prices are still going up from an unaffordable level. That's why when you ask the average person, what's inflation doing? It's wiped me out and prices are still heading higher. That's the problem. And as we heard today from Chair Powell with his press conference and statement at the Jackson Hole Symposium, he's like, hey, what a great job we've done. We can now start cutting rates. So you've wiped out the middle class. Prices aren't falling, they're rising. They're rising at a slower rate, a rate that's way above their 2% target still. And that's mission accomplished. And we're going to start this whole monetary circus all over again. What you just heard now is the truth about how inflation became so high and why I don't think long term we've just begun to scratch the surface on how high inflation is going to go in this country. So I'm predicting we have a truncated period of, right now we have disinflation. I think it could still morph into deflation because the Fed's cutting rates just to follow the bond market lower. The bond market is already priced in at 3.8%. The 10-year Treasury note has already priced in the Fed's rate cuts. Mortgage rates are 5.5%. They've already priced in a series of 100 or so rate basis points and rate cuts. So I don't think we're out of the woods yet with recession. I don't think we're out of the woods yet in deflation. But on the other side of that, you're looking at intractable stagflation as far as the eye can see. So the economy continues to slow, and precisely the reason is because inflation has put on ice 4 of the 5 quintiles. So it's only the top 20% that are really spending. If you ask them, they're doing fantastic. The homes that I own, multiple homes that I own, are at record highs in valuation and prices. My stock portfolio is doing pretty darn well, thank you very much. So, and that's where all the wealth is concentrated, in that top quintile, that top 20%. But if you ask the guy who's renting, if you ask the guy who's, got a manufacturing job, it's disaster for them. So there's a lot of pressure on the economy, the consumption part of the economy, because these people are heavily in debt. Yes, if you look at the consumer in aggregate, they have about 70% debt to incomes, which historically is very high. It's not that they don't have any debt, but if you look at the lower quintiles, credit card debt, auto loan debt, student loan debt, not only are they saturated in that debt, but those default rates and delinquencies are spiking. And I just don't see how, you could just start cutting rates and everything's fine. Because if you look at what happened in the Great Recession, the Fed started cutting rates in the middle of 2007. That was their first rate cut. And they got aggressive in 2008. They went from 5.25% all the way down to 0 by the end of 2008. But that didn't stop the stock market from going to full meltdown mode and home prices from crashing. And we have bigger bubbles in those two assets today than we did back then. Back then, home prices were the salient problem. Well, the stock market wasn't really the issue, but the S&P still lost 50% of its value. Today, you have the S&P 500 and markets as a whole, their total valuation of equities as a percentage of the phony economy, it's almost 200%. Back in 2007, it was just above 100%. And if you look at the home price to income ratio, it's at a record high, even higher than it was in 2006, the previous high, much higher. And of course, when you add in insurance and taxes and maintenance costs, the home prices are just unaffordable. So that's where you're seeing a lot of pressure, downward pressure on the economy, downward pressure on prices, because the natural gravitational forces are for prices to fall. That's the natural state of affairs. It takes a lot of monetary fuel pushing into the market to keep these prices afloat. But if the bank lending isn't there and the consumer doesn't want to borrow and corporations are saturated in debt, and they are, then I don't think you're going to have much of a mollifying effect from a handful of rate cuts that are going to happen between now and, say, the middle of 25. In the year 2000, we had a stock market bubble concentrated in the NASDAQ. We didn't have a bubble in the S&P 500. The bubble really concentrated in NASDAQ stocks. And that burst, and that caused a recession. And the NASDAQ dropped 80%, but it was just a NASDAQ bubble, wasn't it? Wasn't a credit bubble, wasn't a stock market bubble, and wasn't a housing bubble for sure. And then in 2006, we had a housing market bubble. We didn't have a stock bubble. And we didn't have a credit bubble, really. It was a housing market bubble. But today we have a credit bubble, we have an equity bubble, and we have a real estate bubble, all existing concurrently and at record proportions. This cannot end well. The only thing I think that could save us, and I'm not even sure it could save us right now, because I think if the Fed went below the rate of inflation, so if the Fed were to slash interest rates right now to below 3%, so right now we're at 5.25 to 5.33. So you're talking about 200 plus basis points in rate cuts immediately. That might work, but here's the problem. If they did that now, I think the long end of the bond market, so if they did that, ex ante, so before we had a recession, then I believe you'd see the long end of the bond market it would crash and yields would spike. There's a very good reason for that, because you'd have all of the fears of inflation coming back from a very aggressive Fed, on top of the fact that we already have an insolvent nation with $2 trillion deficits in a context of near record low unemployment. So in other words, I'm not a Cassandra. I have a portfolio. The portfolio is up this year, doing just fine, thank you. I'm not sitting there shorting stocks all the time. That's not how I make money. I make money by making my clients money, so I don't spread fear. But I'm monitoring the situation here. I just laid out the situation. The situation is a very unbalanced economy. It's been marred by inflation. We have 3 big asset bubbles existing concurrently. We have an insolvent nation of assets minus liabilities. All those things are facts. So I am monitoring the model that I created, part of the model contains financial conditions and credit spreads. When those internal components, those arcane internal components, start to signal that we've got a problem, then I will adjust the portfolio to be more bearish, more hedges. But right now, we continue. We have some hedges. We do have some gold. I have a couple of bond and bond proxies, which are doing very well in this disinflation, not deflation, disinflationary environment. We've been long India for a very long time. It's been a great trade for us. Getting the timing correct, if I'm right about the bubbles bursting, you need that model. You need to monitor those arcane internal components, and that's exactly what we're going to do. Gold loves negative real interest rates and falling nominal interest rates, which is exactly where we are. What gold hates, what gold gets killed in, that's the environment, is what I would call sector 4 of my portfolio. The sectors go from deflation, disinflation, stasis, reflation, and then stagflation or hyperinflation. Sector 4 is when you have a relatively healthy economy in the context of rising nominal rates, which happens in reflation. Well, we don't have that now. What we have is the Federal Reserve, who is telling you that, hey, we're ready to start cutting interest rates. Here we go. We're going to start cutting rates. We're going to be cutting rates for the next year or two. We're going to take them down to around 3%, from 5.25 to 5.33. Effective Fed funds rate is 5.3%. And that's the direction of travel for interest rates. So nominal rates are going to be falling. And if they're falling in a context where we don't have deflation, remember, gold does not like liquidity crises or sharp deflation. Gold really likes disinflation. So I always start with 5% physical gold in your possession, and then you toggle your investment portfolio of what I call liquid paper gold between 0 and 20. We are at 10% right now in that very liquid paper gold. So think of that like either ETFs or even the gold miners. But in an environment where you're headed into possibly disinflation to deflation, you should be very wary of miners, because miners are stocks, and stocks usually get killed in deflation. So just be careful of that. Me personally, I like silver when we have a global reflation occurring. I just don't see that right now. So you want to see the global economy starting to boom, because silver has an industrial component and a monetary component. So you want to see global growth accelerate, so demand for silver would be strong in the context of some reflation. I don't see that right now. I just don't see it. And remember what I said, the Fed can control short-term interest rates. They don't control long-term interest rates. And if you look at the fact that we've had real positive Fed funds rate now for well over 12 months, so it's well over a year, and they're positive by 2% plus. That's when historically things get really ugly in the money markets and in the economy. So I'm monitoring the situation. The odds are very high for a very chaotic period to occur. At the time, it's just not yet, but I'm watching. If you let's just look at the fact that I don't see either one of these candidates are libertarians, hard money advocates. So I would like to see someone who actually espouses going back on the gold standard, but that's not Donald Trump. And it sure as heck isn't Kamala Harris. Well, some of her policies are just very, very bizarre. For instance, as I mentioned, she blames inflation on price gouging. Well, the margins of corporations haven't changed. It wasn't a sudden epiphany on the part of corporations that we want to start just massively raising our prices for no reason. The margins haven't really changed. So, and then she says she wants to do things like, I want to give, this is her solution to the housing crisis, is to give people $25,000, first-time home buyers, $25,000. From where, Kamala? Where are you getting the money from? And let me see. So the government's giving subsidies. So like when the government gave subsidies for college, did that bring college costs down? All you're doing is increasing demand for homes without increasing the supply. Oh, we're going to limit red tape. You can't do that quickly. You're never going to have a match. You're going to have a massive mismatch between when you start sending out $25,000 checks to first-time home buyers. And listen, my son doesn't have a home yet. He's 21 years old. Man, hey, you want to have a home? You apply for the home. Get yourself a house, Michael. My son. You know how many people that really shouldn't be buying a house would then be buying a house because they have a $25,000 check from the government? So you're putting massive supply on the low end of houses. That's what you would do. Sending prices much higher because the supply would be a big supply-demand mismatch. So it's bizarre. I mean, a lot of her policies make me, think more of Venezuela than the United States. I mean, she's on record saying, and I don't want to get so political, okay? Again, I'm a libertarian, but Kamala Harris is on record saying that she wants to not guarantee, you got me started on this, so I'm blaming you. So the United States is a meritocracy. What we do is we guarantee a level playing field, a fair and level playing field for everyone to succeed if they work hard and if they put in the effort. But Kamala Harris says she wants guaranteed outcomes. She wants to guarantee equal outcomes. That is egalitarianism, egalitarian socialism. You're not going to say, I'm going to give everybody the same opportunity. You're going to say you're going to give this group of people a lot more money so they can end up the same place as everybody else. Well, that's called egalitarian socialism, and that ends up like everybody ends up in the same place like they do in Cuba. That's not where we want to go as a country. It's completely antithetical to what the founding fathers wanted. We have a country here, or we had one, that was based on freedom. You have the freedom not to be hampered and fettered by government. Get government out of the way. And that's what markets are about: freedom, individuals voting with their pocketbooks as to what they want to produce and what they want to consume. But we don't have that. We don't have freedoms. And I point right back to the Federal Reserve. My friend John Rubino did a very good study. If you price GDP in gold, you price the stock market in gold, so in other words, adjust it for an accurate inflation barometer, we don't have much of an economy here. We don't have much economic growth, real organic growth. It's just inflation, stock market inflation, GDP inflation. So in trying to pursue a policy now of inflation on top of what we already have done, it all rests on the hands of the Federal Reserve. This is a huge mistake to start going down the road to make prices go higher. The aggregate price levels rise from here. It's very destructive to a middle class that's on life support.